After this past week, the S&P rose by another 6.89%, meaning we remain up overall in the month by roughly 4.6% and year-to-date nearly 7%, leaving most of us now asking the good old question of which stocks to invest in during these greener days, or some of us, on the other hand, asking whether or not we should be worried for a market shakeup. Therefore, today, I have 7 dividend stocks worth all of our attention right now, just after I mentioned some of our need-to-know macros. With that, investors, are you ready? So as I always do, we're going to get jump started with our macros, which I have to be honest with all of you. For the first time in a long time, I almost feel like there is not that much to actually mention, which is in our favor. Sure, our latest inflationary reading was a tad higher and caught all of us off guard a couple weeks ago, but I think at this point in time, market participants are really just sitting and patiently waiting for the chess move out of the Federal Reserve that will ultimately change the game for all of us, which will be the very first interest rate cut. Of course, I believe we're going to see green days and red days before we actually get to those rate cut announcements, likely going to be made in June or July, but for the most part, I'm quite optimistic.
Bulls on Wall Street are back here. The stock market defying expectations this year. More strategists are putting many bear cases to rest now. So, who are these big bad bulls and what are they seeing in this year ahead? Yahoo Finance's own Josh Schaefer here with the details. Josh, what do you got?
Yeah, Maddie, let's talk about the Bulls, right? Talking about the Bears can be a little sad, right? Let's talk about the big bad Bulls because they're a little bit more excited this year. We know it's been 2024 outlook season on Wall Street, and we've been talking a lot about just S&P 500 projections. You can see on your screen there some pretty big calls. Fundstrat and Oppenheimer coming in at 5,200. From when they made those calls, that's about a 13% increase from where the S&P 500 was. But notably, too, one I want to highlight at the end of your screen there, Bank of America at 5,000. Last year, Bank of America saw stocks roughly flat. This year, they're projecting about a 10% increase.
Nevertheless, we are certainly living in some interesting times, to say the least, as every passing day brings us closer to Election Day in the United States. Global conflicts galore, but I'm going to save all of that for a very different video because we're here to talk about stocks. So let's get focused here on the here and now when it comes to the stock market. As already mentioned, we're climbing up on the year by almost 7%, which I'd imagine we'd really just continue to steadily climb well into the year. And so that begs the question, where exactly should we be investing? And as I always say, into high quality companies that are currently experiencing at least near-term strife, but will ultimately in the long term become victors. So let's cover those stocks now. The first dividend stock I want to add to your watch list actually has the lowest dividend yield of the bunch today, yet the highest dividend growth rate, thus making it a standout long-term pick, especially for appreciation purposes. Nonetheless, let's go ahead and talk about Moody's, ticker symbol MCO, which is a credit rating and risk analysis company that provides analytics, data, and insights to the financial industry, as well as credit ratings on debt obligations. So low-key, a major player within the industry, but makes the list today after the stock fell year to date from over $400 per share to just $380 per share. But now check this out. Over a decade's time, Moody's shot up by over 421% worth of appreciation, and right now, analysts remain optimistic that that share price will rebound, climbing back up to $402.25 per share. It's about 6% or so of upside. And if that doesn't do it for you, let's go ahead and take a look at what smart money has been doing, because hedge funds have been snagging more shares, 1.2 million shares as of last quarter. Now, Moody's doesn't pay the largest dividend, but the growth, as I mentioned earlier, is really something to take a look at here. We got a dividend yield coming in at 0.9%, which is in fact greater than Visa's, but here now we are with the dividend growth rate coming in at 19% on average over the last 20 years, along with a nice dividend streak here, 23 years worth of history. Next up, we're going to go ahead and dive into the real estate sector with Agree Realty, ticker symbol ADC, which is a real estate investment trust that, like all REITs, has been snuffed by higher interest rates. Yet, in time, when rates actually come back down, is perfectly set to soar given the portfolio of theirs consisting of 2,135 properties spanning across the United States, with some prominent clients like Walmart, Home Depot, TJ Maxx, CVS, and many more. Now, year to date, Agree Realty really hasn't fared all too well, down almost by 12%, trading for roughly $55 per share. But again, in this environment, that really makes sense, which is why we must think long-term with Agree. And performance-wise, if we zoom out, we can see a whopping 173% worth of appreciation as they scale their portfolio. And when we look into the confidence of, say, the insiders, well, we have Agree insiders from the CEO himself actually buying more shares to executive members as well, on top of hedge funds that have been loading up up on Agree shares last quarter. As for analysts, they foresee over 22% worth of upside, coming up to $67.50 per share. But let's now agree that Agree is a heck of a dividend stock opportunity, coming in with a dividend yield at 5.36%. That's been on a dividend streak for the last 12 years. Now, investors, there's 2 out of the 7 dividend stocks that I have for you today. But before I proceed, if you take any action today, let it be massive action by subscribing to the channel and joining me on this financial freedom journey. That's all you have to do is subscribe, to which you're going to get now stock ideas and macro need to knows every single week. And while you're at it, let me know that this is in fact the content that you value and that been looking for. Just tap on that thumbs up button to let me know. With that, let's get back to it here with Deere. John Deere, that is, ticker symbol DE, which is an agricultural machine and equipment powerhouse that has actually been quite disrupted by our economic pains in the high interest rate environment that we've been living in, on top of the consumer saving type of environment, as we've been now seeing this stock in the red for quite some time, right now down by 8.7% in the year, trading for $364 per share, PE ratio at 10.6. We do see over 410% worth of appreciation over the last decade, and analysts who foresee more upside, coming up to over 12% worth of upside, bringing that share price to $410.33 per share. All while hedge funds have actually been scoring more shares as well. 1.2 million shares purchased last quarter, and even some share buybacks here in the billions, all promising insights. However, Deere is going to allow an investor to really harvest some dividends, coming in with a 1.61% dividend yield. Again, on the smaller side here, but we do have a 30-year streak with an average growth rate of 13% year over year throughout the last 20 years. Next up, I want to go ahead and talk about a healthcare stock that really has been coming to some lower lows, finally hitting a bottom after winning the COVID vaccine race. Let's talk Pfizer, ticker symbol PFE, which fell to the depths of some low lows here, trading for just $27 per share after trading for the high 60-somethings way back when. Zooming out to a decade, we can see almost 30% worth of appreciation with Pfizer. We do have to realize that this company does manufacture and sell medicines and vaccines, meaning after a few years of a COVID-centric business model, they're surely now due for a new pipeline of healthcare products. And in thinking longer term as an investor, I think this one is a win in a buying opportunity right now. Analysts think the same, with over 15% worth of upside expected, coming up to $31.13 per share, while hedge funds have been loading up on this stock. Over 6.4 million shares purchased last quarter. But this is all about the buy, hold, and enjoy here for the dividend, as we have a yield coming in at 6.21%, which has been steadily growing by about 5% on average over the last 20 years, while maintaining a 13-year dividend streak. And if Pfizer wasn't exactly your type of comeback pick here in the stock market, I get you, but let's now look into United Parcel Service, ticker symbol UPS. It's arguably the world's largest logistics company that has been pummeled by high inflation, coupled with just a lot of cost-cutting measures by just about everybody. So here we are with UPS in the red still, and down by about 5% year to date, trading for $147 per share. PE ratio coming in below 20 at 19.2. Zooming out, we do see over 108% worth of appreciation over the last decade. And what is more here is we have analysts who just continue to predict a strong comeback with UPS, coming up to $165.44 per share. Makes for about 12% worth of upside. We also had recent insider transactions occur at the director level in early February, while hedge funds have been scoring more shares as well. 2.1 million shares purchased last quarter. But UPS is really here to deliver through on dividends, a 4.41% dividend yield. It's been on a streak for the last 25 years, while growing on average by 10% year over year for the last 20 years. However, if you're looking at a little something sweet to your portfolio, there's really nothing like the sweetness of a sugary coffee that keeps sugar fiends coming right on through the revolving doors of Starbucks, ticker symbol SBUX, which kudos to the entire Starbucks team for their forever growing footprint on a global scale and becoming quite an iconic name in the coffee industry. And while I personally would really never want to buy an overpriced mocha choca frappe latte thing, I can tell you this: I certainly hope the vast majority of you keep on doing so, because I love the dividend that they pay me. So have at it as we get to this stock, as it's beaten down $93 right now per share, and it could slip even lower. But you're going to see here that it popped to about $100 per share not too long ago, and then fell right back down in these market conditions. Nonetheless, over 212% worth of appreciation throughout the last decade. Bullish analysts calling for more upside, popping up to $108 per share. It's about 16% worth of upside. And until then, we're going to get that dividend yield coming in at a 2.45% yield, and that's been growing for the last 13 years. years. And check this out, 17% worth of growth over the last 20 years. So there you have them all 7 dividend stocks. Let me know your thoughts on each of them down below in a comment, which ones you own, or if you have better stocks in mind. Now, if you're looking for more insights, catch them all right here. But before you actually click away, just make sure you're subscribed so you join me on this journey now.